Greetings, everyone. It is Employment Friday. My name is Cathie Wood, CEO and CIO of ARK Invest, and thank you for joining this webinar. So, as usual, I'd like to go through a bit of fiscal policy and monetary policy, economic indicators, market indicators, and then I'd like to take you through a letter that I just wrote, give you a sense of it, and you might want to read it. It is on our site now. So let's start. Okay, in terms of fiscal policy, this first chart, so public debt outstanding as a percent of GDP, as you can see, it was hovering before COVID around 100 and seemed to be stabilizing. And then, of course, COVID took over. And the debt accumulation is quite striking. We're at 120%. Now, there are countries higher, including Japan, but Japan depends less on foreign investors to buy its debt than we do. And so that is a consideration and a difference. Now, this cannot go to the moon. Otherwise, interest expense will devour all of government spending. There won't be room for any other government spending. I think we're heading towards 15% now of total spending on interest payments, given the very rapid rise in interest rates. The way we think the debt is going to come down as a percent of GDP is because of the growth in GDP. We think if we're right and GDP growth after a cyclical slowdown, harder landing than most people think, if we are right and innovation takes over and we see very rapid growth, accelerated growth in GDP, then debt as a percent of GDP is likely to come down, much like you saw it doing in the late 90s. The Clinton administration is credited for really being the first administration, I think almost ever, except for post-World War II, to bring down debt as a percent of GDP. So we are not as gloomy on the fiscal policy side when it comes to debt outstanding as others, but it's because of our thoughts about innovation and how rapidly the 5 platforms, so robotics, energy storage, artificial intelligence, blockchain technology, and multi-omic sequencing in the life science space. Those 5 platforms we think are going to deliver outstanding growth in the years ahead and are going to move the needle for the economy. So one of the things we do have to worry about very short term is a government shutdown, March 22nd. This is an election year. I do not believe that they're going to shut the government down. The government dysfunction has really not been a good side for either side of the aisle, or a good thing for either side of the aisle. And so I think they'll avoid that kind of dysfunction. Then monetary policy. Monetary policy. So I've shown this chart before. The lavender or periwinkle line is money supply growth, and the green line is CPI. And as you can see, CPI follows monetary growth. And if this chart is correct and the correlation continues, then the CPI could go negative this year. And I think that the Fed could be shocked at how low the CPI does go. We think it could go lower than what you saw after 08, 09, when the CPI was around 0. And then again during COVID, when it was slightly above 0. We think it could go below that level. And one of the most, I'll get into why in a minute, but rents are a big part of the story. Now, how tight is monetary policy? Here is the federal funds rate minus the CPI. The Fed funds rate is about 5.5 now, and the CPI is about 3. So you can see here 2.5%. If we're right and CPI drops to 0, let's just say it's 0, doesn't even go below 0, then this line will go up to 5.5%. And you'll see that the last time we were there was in the early 80s when Fed Chairman Volcker was fighting inflation, which had hit 15%. Inflation is now 3%. So back then, that was a very successful strategy. Inflation declined really for 40 years on balance. So we're whacking this inflation rate, which we think was less a function of monetary policy and more a function of a supply shock that monetary policy accommodated very short term, and that is unraveling now. So monetary policy, we believe, is too tight. Now, this is the yield curve. So this is the difference between the 10-year Treasury yield and the 2-year Treasury yield. Normally, long rates are higher than short rates. That's a normal cycle. Here you can see long rates are below short rates. The line is below zero. And again, you have to go back to past periods when we're about to hit recession, or again, the early 80s to see the yield curve inverted. Certainly for this long, you have to go back to the late 70s and early 80s. Now, one of the things that I find very interesting about this chart is what it says about deflationary undercurrents. And you can see that in 2020 when the Fed and every monetary authority around the world, there was no controversy, unlike 08-09, was just throwing money at what they thought was going to be a depression. And yet, the yield curve could not get back to where it normally goes in that 2 to 300 basis point or 2 to 3 percentage point range. And what that tells me is that long rates didn't go that much above short rates because they're sensing, or investors in that part of the market are sensing some kind of deflationary undercurrent. Something is not right. And one of the things, and there are many things not right, but we do know that we're seeing a lot of stress in commercial real estate, offices everyone knows about, multifamily. Not many people are talking about it. But if you look at what the Fed was saying this week, it mentioned commercial real estate and offices and other. It doesn't really want to say multifamily units. And so we are beginning to see some distress in that part of the market. And the reason that's important is if you look at the zero interest rate environment effectively had from 08-09 through very recently, what did a lot of private equity, private credit do? It went searching for yield. And multifamily apartments was a big source of yield, and they leveraged up to magnify the yield. So we think that is a problem that is beginning to surface, and we're going to hear a lot more about it. And what does that mean? Well, one of the reasons it's happening is I think there are about more than a million multifamily units. So these are apartment units, part of multifamily dwellings or apartment buildings. I think there are 1 million in the pipeline ready to hit the market this year and next year. For that reason, we think rents are going down. But remember, a lot of the private credit and equity moving into this space leveraged up. So they can't take a lot of rents coming down. They won't be able to service their debt. So we think that is that is the next problem that is going to become obvious and may have been flagged by the yield curve not getting back up into that 2 to 3% range. Another thing to note is that next week, so I think it's March 11th, the bank term funding program that the Fed put in place during the regional bank crisis 1 year ago is going to expire. And you'll see it was used aggressively during the regional bank crisis in 23. Then there was a leveling out. The urgency was not there. The banks weren't going bankrupt. Then now you see, since November, December, another piling in. And we think that's because of what's going on not only in the office part of commercial real estate, but the multifamily part. And this is a regional bank problem. They are much more exposed to multifamily and office than big banks are, to the tune of 25% plus of their balance sheet. So it's an issue. I've always remarked to my team that we often see fireworks during the week that includes March 9th, 10th, and now 11th. Maybe this will cause fireworks, maybe not, I don't know. But very often you'll see inflection points in the market around this time of year for whatever reason, I don't know. Okay, so let's go on to economic indicators. Today we got the employment report, and in it, temporary help employment continued to fall. It is indicating that if we're not in a recession, we will be soon. Now, just in terms of the report today, what we learned, again, something for everyone, just like last month. The non-farm payroll employment increased 275,000. That was higher than the expectation of 200,000. However, the downward revisions to previous months, and every month now we're seeing downward revisions, which is also consistent with a weakening economic environment. The downward revisions were about 167,000. So when you net it all out, employment increased a little over 100,000. Manufacturing employment was down 4,000. We're seeing a lot of weakness in the manufacturing sector as companies cut back inventories. And the unemployment rate, which had been sticky around the 3.5% range, is now at 3.9. Its low was 3.4. There's something called the SAAR rule out there. I think it's SAAR, which says if the unemployment rate moves up by 50 basis points and stays there over a 3-month moving average, then we're heading into a recession. Another thing that happened that was very interesting was average hourly earnings, downward revision to the 0.6%, which was a hot print, as they might say, down to 0.5, still strong. But this month was 0.1. So really 1.2% at an annual rate. And productivity, we know, is growing at roughly 2.5% on a year-over-year basis. If you look at average hourly earnings on a year-over-year basis, 4.3, productivity at 2.5 means that unit labor costs are probably poised to drop below that magic 2% that the Fed is focused on. We saw average weekly hours were up. They were revised up last month slightly, and they were up slightly again this month. It was a fairly weak report, especially when you consider that household employment was down, I think, 185,000, somewhere around that, which means that over the last 3 months, household employment has dropped by nearly 1 million. And household employment is what is counted in the used to calculate the unemployment rate. And it is much more sensitive to small and medium businesses. Lots of food for thought in the employment report. On balance, we think weak, but of course there were puts and takes, and others might choose to focus on something else. This U.S. job quits rate is also quite telling. You can see during COVID, the quit rate went down dramatically because everyone thought businesses would shut down and there wouldn't be jobs anywhere else. So the quit rate dropped. And then you can see during the aftermath of COVID, as people were going back to work reluctantly, the quit rate increased to 3%, which is quite a high level of quits. Why? Because people were jumping from one job to another for higher wage rates. That is changing, and it is coming down fairly dramatically now. This would tell us that the labor market, or corroborate this notion that the labor market is starting to soften. And then on to this notion that we've been talking about for quite some time. We've been in, we believe, a rolling recession. No matter what GDP says, we've been in a rolling recession, we think, for the past 2 years. And you can look at existing home sales, what's happened to them. They're in recession. They're down where they were in 0809 for a different reason. No one wants to move because they've got such low mortgage rates in the 1.5% to 2.5% range, and they're not going to convert to a 6 or 7% mortgage. So, this is a recession in existing home sales. They do seem to be stabilizing. Here you can see new homes sold. Now, what I find interesting about this is new homes were starting to pick up the slack when no one wanted to move as interest rates were rising. And now they too are down. They're down to recession-like levels. So again, a rolling recession. If you look at pricing, this is new home prices. And again, no one's moving from existing homes. So I thought new homes would have an edge on pricing. That's not true. New home prices are down about 2.5%. They were down 15% in the teeth of the crisis, but they're still down, which is interesting. Existing home prices, the median price year-over-year change is back to 5%. It had been down. Again, no one's moving. You have to pay up if you want a homeowner to move and then take on a much higher mortgage rate. Auto sales, another good indicator of recession. It's a mature industry, but you see it tends to peak around 17.5 million units. Post-COVID, we got there for a moment in time, but really this is on a downtrend. We had a severe downtrend and a little bit of a recovery, but I think we're beginning to hear more news about auto sales coming down. They did get to 15.8 in the last report, but we do think that's because of increased discounting. So probably auto profitability is starting to suffer here. And this is another case in point in terms of a rolling recession or weakness. Inventories have been controversial. This chart is from Piper Jaffray. Nancy Lazar and her economic team put it together. And you can see the trend of inventories. Now, these are units, so they're real. You take away inflation. And the trend was steady as she goes, 16, 17, 18. And then you see the big drop as fiscal stimulus began to power Amazon and other online shopping sites. And you see how inventories dropped because people had nothing else to do but shop for their homes and so forth. Now, then you see what happened after that. Inventories were very difficult to get, especially around Christmas time of 21. And so we heard a lot of anecdotes about double and triple ordering as companies were just trying to get anything. And you can see what happened because of that. Inventories ballooned and broke way away from trend. And now you can see they're starting to come back down. This is real retail inventories. If in the GDP accounts, you look at those, you see that real inventory accumulation has not stopped. Retail is starting to come down now, and that's backing up into wholesale and into manufacturing. And it will take another 9% to get back down to trend. This is truly a cyclical indicator, and this will be a reason we believe that we'll see a harder than expected landing this year. Now here is rent. You can see three different metrics here. One is the green is the apartment list rent index, and that is negative. And you see it went negative during COVID, but didn't stay there long enough, started shooting up as people started going back to work and leaving their parents' homes and so forth. So here we are again. It's below zero. It's let's see what happens here. We think these other rent indexes, which are in the CPI, are going to follow, and same with the Zillow rent index. And you can see they're still at 6% on a year-over-year basis. Shelter is the largest part of the CPI. So if this continues down, if it continues to follow the rent down, maybe even into negative territory because of the number of units coming onto the market, record-breaking. We haven't seen 1 million since the incredible speculation of during the inflationary 70s, when real estate was a big tax shelter. It is not that as much anymore. So here we are again, and we believe that rents will come down, and that's why the CPI will go down. Now let's take a tour through some market indicators. The dollar is, again, in perspective, the dollar has been moving up for nearly 10 years on balance. While many people focus on, the last year or something and say, oh, the dollar's weak. The dollar is in an uptrend. And that is a very deflationary phenomenon. Most commodities are priced in dollars. And so here you can see the Bloomberg Commodity Index, and it has been in a downtrend since 2008. And here I like to explain what caused that spike in 2008. It actually started in the late 90s when we had a number of reasons for the Fed to stimulate. Russia defaulted, causing uncertainty, but it wasn't until long-term capital went under and threatened the financial system that the Fed really started easing. That was in 98. And then in 1999, they eased even more out of fear that Y2K, the turn of the century, would knock all the computers in the world out and the economy would shut down. And then during the tech and telecom bust, after the economy did not shut down, but tech and telecom did go bust, the Fed stimulated again. And you can see what happened. It caused that price spike. I want you to remember back to the yield curve, that underlying deflationary undercurrent. This is what I mean. This is a downward trend in commodity prices that started in 2008. And it's resuming its downtrend. And strikingly, commodity prices today are where they were in the early 80s. I think many people are surprised to hear that. Of course, technology is a reason. It's easier to get commodities out of mines and so forth. So that's an explanation. But this suggests that it's not inflationary, that we're not living in an inflationary period today. and that the reason we did have that inflation spurt was a massive supply shock around COVID. And then another way, and I showed you this last time as well, metals to gold. So this is gives us a sense of gold's purchasing power. When the periwinkle line is moving down, gold's purchasing power in terms of metals is increasing. And you can see how tightly correlated this ratio has been with long-term interest rates, certainly since 08-09, but even there was a correlation before 08-09 directionally, until the Fed started tightening. And I think what this is telling us is gold's purchasing power going up in terms of metals is telling us we're in a bit of a deflationary period. And there's been a little bit of a flight to risk-off assets. But you'd never know it from the Treasury yield because the Fed has been so tight. The only way we see the Treasuries expressing concern is through that inverted yield curve. Now I'm going to show you a couple of charts that are puzzling, somewhat puzzling. You can see that gold is breaking out here. Is this a flight to safety? Are there things going on out there, whether it's commercial real estate in the U.S. or recessions around the world, or crackdowns in China and Russia and elsewhere? Is there a flight to safety? We don't know why the gold price is going up like this, but it is interesting to note that the metals to gold price is still near a very low level, near recessionary levels. So that's kind of interesting. Here's the Bitcoin price out to a new high. It did touch intraday on a couple of days that 70,000. And, we wonder how much of this is because of the ETF launches and all of the publicity and the competition among the 11 ETF issuers. And how much of this is flight to safety? After all, we heard New York Community Bank under duress has now been taken over, and there's another bank in Philadelphia. So there's no counterparty risk when it comes to Bitcoin. And so maybe that's part of why Bitcoin has shot up here. And as you know from our research, we think this journey has miles to go. And this is the true puzzler for us. So these are credit default swaps, and they have been coming down. And they came down especially after the Fed put in place that long-term, the funding mechanism in response to the regional bank crisis. Now that's going away on March 11th. Let's see what happens. Could be fireworks. I don't know. But there's another thing that could be going on. And it's back to all of the money, the capital flowing into private equity, private credit funds that don't have to market like we do every day. And to many people, that's a lot more comforting than watching the volatility in the public markets. Well, mark my words, if we're right on multifamily, there are going to be some dramatic mark-to-market moments in those worlds. But we've seen capital stretching for yield in apartment buildings, at one time office buildings, in warehouses, and so forth. And maybe we're going to see the other side of that after this long-term funding facility ends next week. So stay tuned. And now I'd like to do one other thing. I'd like to talk about a letter that I just put out this week. And I'll take you through it just briefly. And if you're interested, you can read it in more detail. But it's called The Journey from Monetary Shock to an Innovation-Led Economic Boom. And so the journey back, we believe, started last year. As you will recall, our strategies, any long-duration strategies, including bonds, were hammered in 2022 as the Fed jacked rates up at the fastest rate in history. And last year, we began to get a sense that the Fed was near the end of that move. And the market started responding, and our strategies started responding. So we're calling this the journey back, certainly from our strategies point of view. And we feature in there the Bloomberg Commodity Index that I just showed you, but also the same index in real terms, which is as low as it was in the early 70s. So the great inflation started when the U.S. closed the gold window in 1971. And it has taken 50 years to get back to those price levels in real terms, so adjusted for PPI inflation, which is kind of interesting. And then we go into the Fed still fighting the war that we believe was starting to end in 2008 when commodity prices peaked. And we think they have probably, in their tightening moves, set the course for a deflation in the next couple of years. Deflation, simply the other, partly because of monetary policy, being too tight, the yield curve inverted, and so forth. But also deflation because of innovation. COVID really lit the fire under innovation. Innovation solves problems. Global digitalization came of age in a big way. And we saw all of the fundamentals that have been driving robotics, energy storage, artificial intelligence, blockchain technology, and multi-omic sequencing. Those continue to improve. Again, we believe that the Fed will stop and reverse as commercial real estate continues to weaken and as inventories come down and we have a harder landing than anybody now expects. One of the reasons we think that this is going to happen, and I've mentioned it in talking about unemployment, is corporations are losing pricing power. If they want to keep the consumer, they're having to price down. It was interesting today to see Costco disappointing. And Costco, of course, bargains galore. Costco disappointed. Walmart didn't. But it did talk about deflation, maybe not as much deflation as it once expected, but it is talking about deflation. Companies are losing pricing power. They will lay people off. And what's been so astonishing as we've gone through this earnings season is to watch how many companies are watching or are reporting negative revenue growth. In other words, revenues falling on a year-over-year basis. 3M almost down 2%. UPS down almost 8%. Kraft Heinz 7%. ExxonMobil down 12%. Thermo Fisher in the life sciences space, that's typically a steady Eddie space, down nearly 5%. Home Depot, down nearly 3%. Cisco, down nearly 6%. Texas Instruments, down 13%. We've heard a lot about AI and NVIDIA and, the other beneficiaries of AI. And yet Broadcom, which is a beneficiary of AI, reported last night, yes, AI-related chips up 35%, or their expectations are that for this year. But if you look at what happened to overall semiconductor solutions, they were up only 4%, slowing down dramatically. So we think that we're going to have a little bit of a harder landing. And one of the things that could be reassessed is how companies harness AI. And what we think is there could be a bit of a pause for a couple of reasons. Well, first, if we do have a harder than expected landing, but maybe more important, because companies really have to do a lot of legwork to get ready to harness AI, and which means they have to integrate data from far-flung places around the world to activate AI, and they have to map out workflows in excruciating detail in order to enjoy the productivity gains that will come out of AI. And it's going to take some time. It takes us back to the early days of the internet when Cisco went through the same thing. Cisco had a brilliant move in the 3.5 years leading up to March 1994. And one of the reasons, the aha moment, the ChatGPT moment back then, was when AOL, when its email was connected to the internet for the first time. And so that was in 1993. Cisco just took off, soared 30-fold or more. And companies then, as competition started to enter the space, and there is competition entering the AI chip space, different kinds. The hyperscalers themselves are developing their own chips, AMD, Tesla. Other companies large enough to develop their own specialized chips are doing so. And so there was a moment, there was a bit of paralysis. And Cisco had a very significant setback, and then went on to years of very strong growth as companies got their ducks in order and started committing to this internet backbone. We think NVIDIA could be in the same position, and not taking anything from NVIDIA. All praise to Jensen Huang. Everyone knows that NVIDIA is the AI stock, and everyone has piled into it. There's been a big momentum move here. A lot of the investors that have piled in are very short term in their time horizon, investment time horizon. And if there's any little hiccup, just like there was in the fourth quarter of 2018 during the crypto winter, they will flee. So it's just, that is why we get the question all the time, are we pulling back on NVIDIA? It is simply for that reason. And yet we think NVIDIA is in one of the best positions among all companies when it comes to the AI age, which is truly a profound age. But once the cyclical correction is complete, AI is going to take off, and it's going to catalyze all the other technologies that we have centered our research and investing on. And we think it's going to lead not just to exponential growth opportunities, like Amazon delivered 20% at a compound rate in revenue growth over 20 years, but super exponential growth, a rapid growth rate accelerating as these technologies converge. So if you'd like to learn more about that, please check out our Big Ideas 2024. You'll see the building blocks of how we get from $15 to $20 trillion in market value associated with disruptive innovation now to $220 trillion in the next 5 to 10 years. So one of the biggest opportunities for wealth creation in history, we believe. So with that, I will end by giving you a preview of a few of content pieces that are coming out. We had the pleasure of interviewing Andre Iguodala. You basketball fans will know Andre and Evan Turner, who have their own venture capital company and have a passion for education, as we do as well. So very much cut from the same DNA, and it was just delightful speaking with him. We have Bitcoin Brainstorm was just released, and that's a monthly webinar. This time was around mining and how mining and energy storage are going to work together in a provocative way to lower damage to the environment. We'll be putting out our Bitcoin Monthly next week, so stay tuned for that. And finally, we'll be putting out a paper. I've probably given you a sense of it for 3 or 4 months now. These things do take longer than even we expect. It's our convergence white paper. Brett Winton, our chief futurist, has pulled it together, and we should be publishing it within the next few weeks. I think I said that last month, but it is the next few weeks, we believe. So until next Employment Friday, thank you very much, and have a lovely weekend.